Coming up today, stocks finished the week higher. What happened to September seasonality? Are we heading into a bull trap? We were promised a recession. Is inflation still coming? The risks to markets? Why miners could have further to go? And prepare yourself for what's coming next. It's going to be great, guys. Let's go. And welcome back to the Daily Market Review. I'm your host, Jared. I'm going to get you all up to date on everything important happening across the stock market today, so you know exactly what is going on out there. And as usual, the heat map doesn't tell the full story, as there are so many hot stocks on absolute fire today, and I'm about to show you soon on the charts. But first, let's just take a look at where we stand in the market overall. We've got bullish sentiment returning. Fear and greed index climbing to 62, still well off the extreme greed zone, as there's still plenty more bears out there yet to capitulate. And we saw that with the latest investor sentiment survey this week. Still slightly more bears than bulls, but the bulls have come back in a big way this week. But again, the average bullish readings are still well off what was seen in the last 2 years, meaning there's still room to run in this rally. And it's not all retail investors either. It's actually mostly big money institutions that had been sidelined and were screaming at us a recession was coming back in the tariff tantrum in early April. But it looks like they've been forced to jump on board this rally. And we just saw the biggest weekly equity fund flows since October last year, as we still come off very low overall positioning and sentiment. Looking at multiple measures, net futures positioning, foreign investor net demand, active equity fund flows, we have seen a little pickup in margin debt, but overall sentiment still doesn't match that of a roaring bull market. And what happened to September seasonality? Historically the worst month of the year. Guess we still have a week and a half left. However, all key stock indices just had another good week, with all of them including the Russell 2000 sitting at all-time highs now. But no doubt the second half of September, which we're currently in, is the weakest 2-week period of the year. But the bull market just got a big shot in the arm on Wednesday thanks to Jay Powell finally cutting rates. And whilst overall equity positioning and sentiment still isn't at extreme high levels, no doubt technically on the charts, we are a little stretched in the short term, which can usually give us a pullback over the next couple of weeks. So for sure, I wouldn't be surprised if we get a pullback next week. It's kind of almost expected after a really good run, or at least a consolidation within a still healthy uptrend. But the indices did just make a new all-time high in this month. And when we get that bullish signal in a bearish month, we typically finish the rest of the year higher 90% of the time. But like I said, there's plenty of bearish sentiment and pessimism still out there. I can see it in my social media feed. I can see it across financial media. Another one today in Barron's, beware this bull trap as stocks keep hitting new highs, making the argument that the Dow Jones Transportation Average is down more than a whopping 1.5% this year, not confirming Dow theory. Keep in mind, that's just one theory. The world isn't that simple. There's a lot more going on than just Dow theory. And just looking at the monthly chart of the transportation sector ETF, we're literally only 5% off all-time highs. So it's not all that far away from confirming Dow theory anyway, which suggests that both the Dow Jones Industrial Index and transports should be breaking out to highs to confirm the bull market. And I guess we have to keep waiting for the so-called promised recession. Been going on a couple of years now. Economists keep pushing it back next quarter, next year. But now the alarm bells are ringing as loud as they have done in a while. But economists are notorious for getting it wrong. Back in 2007, 2/3 of economists didn't even see a garden variety recession coming. Then back in late 22, going into 23, 2/3 of them again expected a recession to begin within a year. And as we know, it didn't happen. But now we're back to big calls for a recession all over the place, thanks to a weakening jobs market. And that's not to say it's not possible, but right now the price action in the stock market is so strong. Corporate earnings are strongly uptrending. We really need a big tectonic change out there to even get close to a recession. Because in my opinion, artificial intelligence is causing a massive boom in corporate earnings per share. And that growth is actually forecast to accelerate next year. Looks like the S&P is going to do about 12% year-over-year growth this year. Should come in around 270, and then we very well could beat estimates of 305, even potentially 310 or more next year. And this is the biggest driving force of the stock market. Not to mention we've got probably the most bullish US administration in history, helping to accelerate the bull market, with the White House literally posting their own memes. Don't be a panicking. S&P 500 rallies to high, and the president himself posted a meme of buying the dip on Intel, likely given the nudge to NVDA to make a relatively small $5 billion investment in Intel, helping to send shares sharply higher. And I expect to see more and more direct involvement in the markets from this administration as they continue to execute their America First agenda. But in my opinion, the real opportunity now is in small cap. Russell 2000 small cap index just made a brand new all-time high yesterday, taking out the highs from November last year, which were pretty much the exact same level where the Russell peaked out prior to that in November 21. And since that prior peak, the Nasdaq Qs are up over 53%, with the S&P up almost the same, 50%. The rest of the world, looking at international stock market, we're up 27%. Even short-term bonds have done better in the last 4 years. The Russell 2000's only just broken out, and that is a very bullish signal. Even though we're having a little pullback here today, breaking out to all-time highs, and you can backtest this, bodes very well for forward returns. Blue sky territory, there's no overhead resistance, and everybody that's long is in the money, or they should be in the money. And so in my opinion, prepare yourself for potentially a strong outperformance of small caps in Q4 and going into 2026 on the back of interest rate cuts, which small cap stocks absolutely love, and coming from a spot of a huge divergence with large caps, not only technically speaking, but also in valuations too. Small caps are significantly undervalued relative to large caps, and we're already starting to see that outperformance over the last month, coming off this long multi-month base. And again, not even the Russell 2000 shows the full picture. We've got a lot of story stocks out there, small cap growth stocks, those really sensitive to bull markets, often acting like long duration bonds, sensitive to interest rates. Once again, seen some huge moves out there today, and I'll run you through a list of a few here. AST Space Mobile, up 8%. Monster rips in quantum computing stocks today, and there's a lot of momentum out there across many different asset classes around the world. Saw that once again with miners having a really good day. Drone stocks like Unusual Machines, close to breaking out again, and some of these theme stocks that had really pulled back the last couple of months, perking up here like Archer Aviation, electric vertical takeoff stock, and one of the best performing small caps up until late August. Like I told you guys back here, expect a big correction for New Egg Commerce. It just got way too heated, literally more than 120% above the 50-day VWAP, which then literally had a near 80% drawdown. Remember, in a bull market, hot stocks can still have massive corrections, but that looks to be perking up here today, and if this gets above the 50-day VWAP, it could go for another run. And one stock I recently invested in as part of my stock picks portfolio, which I believe has huge potential, and that's Lemonade, which you could kind of think of as a pure play on a revolutionary AI-driven insurance business that other well-entrenched incumbents can't compete with, as they're too bogged down in their old ways and infrastructure. And insurance is potentially the biggest industry on the planet that is still yet to be disrupted. Current market cap $4.5 billion. This could potentially be a $100 billion company over the next couple of years. AI data center stocks having another great week, leading the pack Iron, renting out GPUs and their data centers powered by low-cost renewable energy. Other AI stocks waking up there today, Pony, again big double-digit moves on huge volume, as this was a quadruple witching day, and I'll show you later on the option stats we got from today. It was a absolute monster out there. Other small AI names like Big Bear looking really strong on the chart. Serve Robotics breaking out was another great week for robotic related stocks, including one we've also got in the stock picks portfolio, Symbotic warehouse automation. Partnered with Amazon, I think this stock too has a lot of potential in the coming years, as warehouse workers are quickly getting replaced with robots. And one of the best performing small cap stocks this week was Amprius Technologies, which is actually my most recent stock pick, which I sent to members on Sunday, and I purchased it the next day on Monday morning at $8.40 a share, and it's already up over 40% just this week alone. And they make a revolutionary silicon ion battery, which is a lot more efficient than the traditional lithium ion batteries made using graphite. And so I've been seeing some big moves in the battery industry this week, and just new age energy in general. Nuclear having another monster week. Another stock we've got, Nano Nuclear Energy, up 21% today, along with the small modular reactors, Oklo slapping on another 28%, and NuScale Power also waking up, along with uranium miners, the largest in the world, Cameco, pushing up to highs. Same with Centrus Energy, another momentum upward thrust on the chart as the commodity itself continues to push up. Looking at the Global X, uranium ETF up over 8% today. Keep in mind, uranium, unlike other commodities, doesn't trade on a futures exchange. Instead, the price of it is negotiated between producer and buyer. But on the back of the news of US and UK making it a focal point to work together to unleash its full potential, the market is now really starting to price that in. One of the best performing sectors over the last 6 months. And stick with me, because later on in this video, I'll show you the best performing ETFs along with the top 100 ETFs according to my unique momentum formula. And you might be surprised at some of the names and sectors in there. And I'll also share with you a list of stocks that could potentially break out next week that aren't super stretched on the chart. Like many of these stocks are, we're getting these reversal signals. Like I said, we very well could get a consolidation and pullback next week, which is what you want to see in a healthy uptrend. We don't want to go too parabolic short term, because then we're just going to have a big correction. And so before I get back into the charts and show you what else is hot out there today, let's just look at a few other things and why small caps are really lighting up this week. A lot of these growth stocks borrow and receive investments, and that's what makes them sensitive to interest rates. The cost for them to work towards their ambitions gets cheaper, along with their financiers. Cost to invest in them comes down as well, along with servicing existing debt, and that helps to fuel a bull market if the economy is still holding up. The Fed's not cutting rates it's because the economy's fallen off a cliff, but rather because there's softness in the labor market, which the stock market doesn't seem to mind. And it's actually been going on for a few years now. And Fed Fund futures are actually pricing in that we could very well likely get 2 more cuts by the end of the year, and even potentially get down to 3% come mid next year. And so that's a great tailwind for the market. The only real risk to that is a big uptick to inflation, like JPAL's been telling us all year. That's what tariffs were going to do, along with the rest of the media and many other so-called experts out there. But the reality is we've seen a little few bump ups in some select categories, but nothing like the tsunami of inflation that we got in 2021 after the Fed printed $5 trillion new dollars and said inflation should be transitory. I have no idea what their 100 PhDs do, because it doesn't take a rocket scientist to figure out that was going to cause inflation. But tariffs, on the other hand, not so much. If the government's just adding a tariff on some goods, that's not creating new currency. That's just making something more expensive. The government taking the difference and putting it back into the economy. Now the Fed's starting to finally realize that tariffs aren't inflationary. Like I've argued all year, we may get a little bump up as they filter through the economy, but nothing like a big structural wave. Plus some other policies out there creating softness in the jobs market could also be placing downward pressure on inflation forces. There's not to say that there's still not a lot of embedded inflation out there. Prices have gone up a lot over the last 5 years. Plenty of people still feeling that. But markets are great at adjusting to new reality. And so we've actually seen a sharp decline in the imports of consumer goods, actually taking out decade lows. Along with industrial supplies, cars and food all coming off a little bit this year in the percent of import. What has gone up is capital goods. Businesses front-running those tariffs, and America's going through a huge capex boom. Companies spending big on new data centers, infrastructure, and so they are having to import some capital goods to set all that up. And generally speaking, if the economy holds up after the Fed starts cutting, stocks continue to go up and have a pretty healthy forward 12 months. And markets seemed to have seen this coming. Ever since the 10-year yield made a swing high back in mid-July, yields have come down in anticipation of Fed rate cuts, and rate-sensitive sectors have performed really well since then. Like a lot of those stocks I showed you, they're non-profitable tech-related companies, long-duration assets, and of course other sensitive sectors like home builders and companies that have a lot of floating debt that adjust with the market. As I said, the cost of capital's come down, and that's why those sensitive areas like biotechs and small caps and long duration assets have been outperforming large caps. But don't get me wrong, it's not like there's no risks to the bull market. There's always risks. Nobody knows exactly what it will be to end this bull market, but it could be one of a few things. It will be interesting to see if the jobs market does go into a persistent contraction, if GDP and corporate earnings can still hold up, because job growth has dramatically slowed this year, but there's still just so much money out there. I see it every time I go to America. You go to places like LA, Vegas, and Miami. The amount of wealth out there is extravagant, with wealthy consumers spending at all-time highs. And with the stock market at all-time highs, they've got no reason to slow down. With US household wealth up $6 trillion so far this year. And even though we've seen a little contraction in GDP this year, thanks to a negative Q1, distorted by a huge amount of imports and front-running of tariffs. Nonetheless, the US economy should have still grown around 2% this year, even though government spending, which was a sizable part of economic growth over the last couple of years, as shown here in the purple shading, has actually gone negative this year, along with residential investment. What we're actually seeing a big expansion in is non-residential investment, and that's the AI capex, companies spending a lot of money. That's really helping economic growth a lot, and consumption is still holding up, even though it's a much smaller percent of prior year's growth. Another risk to the stock market is climbing global bond yields, especially in long duration. 30-year yields ripping up to decade highs all over the place. No doubt adding to the skepticism and pessimism out there, which is a legitimate concern, especially if they were to keep going higher and higher, just raises the hurdle for what stocks have to yield to be more appealing. But I think a large part of this is normalization, coming off literally all-time lows in yields. Japan and many parts of Europe had negative bond yields. In other words, large institutions were paying the government to lend them their money. And as crazy as that sounds, it's because they have mandates to stay invested in bonds regardless of the yield. So yes, if long duration yields keep ripping higher, that will put pressure on global equities, but they could just as likely pull back and consolidate for a few years after a period of normalization. We got that big V-shaped recovery. And so, of course, the secular bull market will end at some point. Could be next month. It could be 5 years from now. Nobody knows for sure. We could be in a bubble. We could be about to go in a bubble. And typically, it's the last year or two that's the most crazy, and you see the biggest percentage gains. Things really go vertical, and the average duration of historic bubbles is only 2.5 years. But we normally see a much higher valuation than what the overall market has right now. S&P currently trading at 24 times earnings. Like I said, it can go a lot further looking back in history. But when the bubble does pop, that's what usually washes out a lot of investors, especially those that are leveraged either through margin or just being overexposed to whatever's really driving the bubble. And that's why we can see an average decline of 68% in the following year and a half when the bubble bursts. And so what you'll notice looking back in history at this asset class quilt of total returns, going back to 2000, ranking 10 asset classes by the highest return for each year. Quite often, the best performer one year can flip to the worst performer the next year, like commodities in 2001. Emerging markets in 07 to 08. REITs were doing really well in 06, some of the worst performers in 08. Treasuries did well in 2011, one of the worst performers in 2012. Gold did well in 2020, was the worst performer in 21. Commodities can often flip, and along with international stock markets as well. Gold's now been the best performing asset class for 2 years in a row. I do think it's a little stretched here, due for a bit of consolidation, and very well next year may be different. What looks better to me though is commodities in general, especially miners, as they haven't had the crazy outperformance as gold has done the last 2 years. And just like small caps, mining stocks are also starting to outperform, coming off multi-year lows, not only technically speaking, but also valuation and overall investor positioning. In fact, the mining industry as a percentage of global equities is now only 1%. This is something none of us have ever seen before, but the world will still need commodities to make everything for hundreds of years to come. And with the price of crude oil so low, making mining operations less costly, and now with lower rates as well, a lot of miners rely on debt to finance their operations. That's why we're seeing big outperformance this last month of the mining sectors, doing even better than gold and still with room to catch up in my opinion. And just looking at a few ETFs, my current model ETF portfolio is holding, helping to drive a huge month for the portfolio, up over 8% just in September alone. The Van Eyck Junior Gold Miners ETF up 5% today, and the Global Silver Miners ETF up 4% today. And look at all that volume coming this month. That's big money really starting to hop on board. And so us as small investors, we can kind of front run that big money, kind of like a fly on an elephant's back. And that's our biggest advantage as small investors. We're much more nimble. We can get in and out a lot quicker than them. They take days and days, if not weeks, and in some cases months to get in and out of a market because they have to move billions and billions of dollars around, suffering huge amounts of slippage and adding to these big trends. Another one in my ETF portfolio helping to drive gains this month, the Nuclear Renaissance Index ETF, also having a big day breaking out. And I thought I'd share with you guys today a sneak peek inside the ETF portfolio members area. At the start of each month, I'll be sending out a monthly report, letting my members know what ETFs I'll be selling and replacing them with, always holding a combination of the top 10 strongest ETFs out there. And so you'll always be able to see my current portfolio in the members area, along with performance tracking from my real money brokerage account that I'm running the strategy in, including all trading records and trading history. But what I've also got in the members area is the top 100 ranked ETFs according to my unique momentum formula. And this will be getting updated every Sunday. And so new ETFs I'll be investing in each month are drawn from this list. And so my formula uses multiple things. It looks at traditional measures of momentum, performance, but also bakes in a few other things. Short-term performance, volatility, proximity to 52-week highs, and a few other things I won't mention here, but the basic principle is to identify the strongest assets in the world. So it's obvious to see from this list what has the hottest momentum is digital assets, Bitcoin miners. With the number one being the CoinShares Bitcoin mining ETF is literally more than tripled since April lows. Huge amount of momentum, but like I've been noting, a little stretched here in the short term. But again, my strategy doesn't just buy the top 10 according to this list. Otherwise, it would be too overexposed to crypto. And so if it has a big pullback next month, 10, 15, 20%, I don't want my portfolio to pull back that much. And that's why part of my momentum strategy is to always hold a diversified portfolio of assets from this list. So it's got multiple categories, not having too much exposure to one. And so I thought I'd add this list into the members area for you guys to see what are the strongest assets out there. And I'll also be using it to share with you guys here on the daily market review. What are the best performing assets? In addition to helping my stock picks research, as I'll always want to have positions in small cap stocks from within these sectors. It can also help my options trading, identifying the strongest sectors. And so in addition to crypto, what else has been performing well is Cathie Wood's ARK Fund, the FinTech Innovation, Technology and Robotics, and her flagship fund, ARK-K. Also showing up gold miners, uranium, nuclear, space stocks, silver miners, defense technology. China's broken out of late, stocks that have a lot of social sentiment, and other ones you might not even be aware of, like the Metaverse ETF and the Van Eyck Video Gaming and Esports ETF. Who's talking about that? Yet it's been one of the best performing sectors over the last couple of months. Plenty of momentum here. with really low volatility, and that's what my formula rewards. Also in the top 100 ETF list, a few countries, Greece, Vietnam, and Spain. And so all ETF portfolio members will have access to this list, updated weekly. And like I said, it's from this list where my system draws new picks from at the start of each month. Portfolio gets rebalanced monthly. Then I have another unique formula to determine when an ETF should be sold, quite often having to fall off this top 100 list, and a few other filters as well, in order to reduce turnover, with three basic principles to my ETF momentum strategy. The first being always hold the strongest performing assets. The second being always having a diversified portfolio, not too concentrated in one category. And the third being keep turnover low to reduce trading costs and ride trends for as long as possible. And so if you're interested in learning more about my new ETF portfolio service due out on Thursday, come back to the daily market review, because on Monday night, I'll be giving a slide deck presentation letting you know all the details about this new service and exactly how it's all going to work. And if you'd like to learn more about my ETF strategy today, then click the link below this video, head on over to my website, clickcapital.io, and get my free ebook before I pull it down this weekend. This is your last chance to get it, as I'll never be posting it online again. And inside, I go into more detail about what I call the global all-weather ETF investing strategy and how I've used it for nearly 3 years now in one of my accounts. And I'll also show you proof how that's delivered me a 65% return. And that's using no leverage and just 10 minutes a month. It's a really low maintenance strategy. You don't have to stay glued to the screen all day, which is perfect for any long-term account. And in my opinion, is the best way to protect and grow wealth with a diversified portfolio. So again, grab this ebook if you haven't already, and then you'll be on my email list and amongst the first to find out when the ETF portfolio service opens next Thursday. Okay, just moving on, looking at Tesla. Wall Street is coming back in a big way, starting to upgrade their price targets all over the place, which is a good sign because quite often that can act as gravity towards the stock price, as a lot of their clients follow their recommendation. We're now seeing price targets above prior all-time highs, with some going as high as 548, and that's thanks to anticipation of Tesla's new product lineup, the Cybercab two-seater, completely automated vehicle, the Optimist bot, the robo-taxi, and the robo-van, all coming for a market near you, which they're trying to roll out as quickly as possible, helping Tesla have a great week, gapping up to start on Monday. But again, a bunch of reversal signals. We could see a pullback next week, which could then consolidate and find its feet again, as Tesla too really loves lower rates, selling big ticket items sensitive to the cost of capital. Also helping markets today, Apple having a strong rip, 3.2% as the iPhone 17 goes live. Looks like the market is anticipating a really good upgrade cycle. Still a bit of consolidation for NVDA, but looks to be holding up pretty good. Not all that far off all-time highs. There was another monster week for Alphabet Google, starting Monday, slapping on 4.5%, crossing 3 trillion market cap for the first time ever. That was great to see. Same deal with Uber, popping up 4% today, after once again announcing another partnership with Flytrex, introducing drone delivery for Uber Eats, as the threat of robo-taxis isn't denting the potential for Uber in my opinion, nor market enthusiasm it seems, sitting very close to all-time highs here, and is sharing a list of other high momentum stocks, like I said at the start of this video, that could have the potential to break out next week. Ondas Holdings, involved in wireless radio systems, SoundHound AI, and it too, not showing any reversal signals yet, like many other small hot names are, close to breaking out. Another AI infrastructure stock, Nebius Group, calling up just underneath highs. CoreWeave looking good, still got a bit of room to get back to all-time highs. Tempest AI had some reversal signals last week, but largely spent this week consolidating, potentially setting up to break out again. And another hot name, not looking too stretched on the chart here, but definitely forming a really strong bull flag pattern. Red Cat Holdings could be another one that could potentially break out next week if the market doesn't have a big pullback, of course. And so today was Quadruple witching. In fact, it was the largest one in history. Over 5 trillion in options expired today. Me and my members were certainly busy in the chat room today. After having another great week, there's a look at the top 25 most traded options in the market today. As usual, Tesla out on top, but some of these smaller hot names like Oklo also showing up there. And a few other crypto names, even though crypto was a little soft today and this week. And total volume came in at over 73 million options contracts trading hands. Monster day, 65% calls. And just looking at the S&P 500, now completing the 5th reversal candle. The last time we got 5, we just got a quick one-day pullback. It was the biggest down day since April. Not as stretched though on the Russell 2000. No reversal signals yet, but definitely there for the tech-heavy Nasdaq index. And volatility still remains really low, with the VIX just above 15. Bond yields stabilized this week as the market saw the cuts coming. I think that's overall a good sign. And the dollar as well stabilizing, but still could be in this downtrend. I think the government and maybe now the Fed are not going to mind inflation at 3%. As I've been saying for a while, 3 is the new 2. And overall, historically, most global central banks aim for that 1 to 3% band. Got to allow a little bit of flexibility. Can't be so hard-nosed about hitting 2 on the dot. And looking back in history, you'll find Governments that have a lot of debt will almost subconsciously and naturally try to inflate that debt away by debasing their currency. And the US is in the best position to do that, being the reserve currency. It's pretty much permission to print at will, just like they have done. Because if the dollar did get so cheap, more and more people would invest in the States. It's still the most sought after location in the world for people to relocate to. Still attracts the world's talent. And in fact, the whole United States is an anomaly. Only 249 years old, set to celebrate its 250th birthday next year from the Constitution. Think about that. The USA is only 3 full lifetimes old compared to other economies in Europe, Japan, China, thousands of years old. And that's because America is built on risk takers, entrepreneurs, and opportunists, something that was true 300 years ago, and I would say even more true today. And so that should naturally keep a floor on the dollar, even with inflation, and even if we did get more money printing. But that just kind of forces you to own assets. Otherwise, you're going to get left behind. And so there's no telling how far the secular bull market and US tech stocks could go. No doubt we will eventually get a big correction and bear market, but it could find its feet again and keep going. And the best way to participate in that is not by guessing, is not by hoping, but by simply following a systematic strategy, keeping you invested in the best performing assets, no matter where they are in the world. If US stocks are going to keep ripping for another 5 years, my ETF strategy will be invested in them. If there's other areas, international markets, commodities, miners, crypto that do well, I'll be invested in those as well. Diversification is not only the best form of defense, but also for offense as well, participating in the strongest trends out there. And so if you'd like to follow my new $100,000 account where I'll be running this ETF investing strategy, then come back to the channel on Monday night where I'll be giving a slide deck presentation, letting you know all the details. Then I'll be accepting new members on Thursday, along with a big discount for launch week only. It'll be the lowest price I ever sell access to this service for. And if you're interested in getting access to my other premium trading services, like my stock picks or my private options trading chat room, then I'll also be extending that big discount to package deals that include the ETF portfolio. And that'll be your chance to buy the dip on some premium Click Capital services. And so on the 1st of October, I'll be buying 10 ETFs and letting members know the day before exactly what I'll be buying, just like I'll do on the first day of every month. And as a final reminder, this is your last chance to get my free ebook explaining the strategy a bit more in detail. Click the link below this video to send to your email and you can read it right away before I pull this page down this weekend. Otherwise, enjoy your weekend. Thanks very much for tuning in. I hope you're making money out there and I look forward to telling you more about my ETF strategy come Monday night. Cheers.